Let's take a look at the general information about inventory. At this point, we have been going forward with talking about primarily merchandisers, those kind of businesses that take inventory that they have purchased from somewhere else, and now they're turning around and reselling that same inventory. And so now we're going to talk about the actual inventory itself and how to account for it. Inventory represents the cost of the products the business has made if they're a manufacturer, or purchased if they're a merchandiser, either a wholesaler or retailers. Both are merchandisers. Okay, which it then plans to sell to customers. Okay, so the business owns the inventory up until the time it's sold. So we set up an asset called inventory. There's two types of systems for keeping track of the inventory. The periodic system, which means we're only periodically recording in the inventory account, usually at the end of each period or each month. And this is the system we covered in Chapter 11. So when we purchase inventory, we would debit an expense account called purchases. We don't put it into the inventory account itself. Okay, with the perpetual system, we are perpetually or continually recording in and out of the inventory account, so the balance is always up to date. If we take a look at a couple of differences between these two types of inventory system, if we look at the inventory account balance, in the periodic system, since we're only recording in and out of inventory periodically, then whenever is the end of last month, we counted the inventory, we calculated it, we put it into the inventory account balance, and then it just sits there all during the month. So if I counted it on July 31st, that becomes the beginning inventory for August 1st, and then it just sits there. That same number just sits there in the inventory account the whole month until the end of August, and then I will count the inventory and readjust the inventory balance to fit the end of August, which becomes the 1st of September. In the meantime, we don't do anything with the inventory account. Whereas in the perpetual inventory system, we are constantly recording in and out of inventory. So inventory at any moment in time reflects the current up-to-date amount that we have of the cost of inventory. Now, if I go back to the periodic system, we talk about purchases and sales of inventory. Well, when we purchase inventory in the periodic system, just like what we did in Chapter 11, we debit an expense account called purchases. And if we sell inventory, no extra entry is made about the cost of the inventory. So if I sell something for $10, I'm going to debit cash and credit sales for the $10 that I charge to the customer. It has nothing to do with whatever it cost us for that $10 item. Now, in the perpetual inventory system, when we purchase inventory, it's coming into the store, and every time inventory is coming into the store in the perpetual system, we're going to debit inventory. We don't even have a purchases account in the chart of accounts. Okay, we're going to debit inventory when we have purchases. And then when we sell stuff, we're going to calculate, we have to calculate, well, how much did this item cost us? So I'm still going to have the same sales journal entry. I'm going to debit cash and credit sales for that $10. But now I have to figure out, oh, this thing cost me $6. And so I'm going to now debit an expense account called cost of goods sold, and credit inventory. So the cost of the inventory coming in is debited to inventory, and the cost of the inventory that's going out and being sold is credited to inventory. Going back over to the periodic system, the current inventory balance is only calculated once at the end of each month, and the cost of goods sold is calculated. We don't have a separate account in the chart of accounts for the cost of goods sold. It's just something we calculate at the end of the month. We actually take a physical count of the inventory. We calculate out what its cost is based on that physical count, and we calculate out what the cost of the goods that we sold that month from that physical count. We do that at the end of each month. In the perpetual inventory system, there is no need of the end of the month adjustments because we're constantly keeping the inventory account up to date. So I don't need at the end of the month to count the inventory, calculate out the cost of goods sold, calculate out the ending inventory. I don't need to do that. It's already done. Right along as we go along and along. Every time I sell something, I'm crediting inventory. Every time we purchase stuff, I'm debiting inventory. So the inventory is always up to date, and we don't need to do that end of the month count or calculations or adjustments. Now, GAAP does require us to do an actual physical count of the inventory at least one time per year at the end of the fiscal year. So we will have to do that. And of course, there's always some stuff that happens, like some stuff got stolen or some stuff got busted and the stock clerk didn't realize that was something that needs to go in the accounting books and they just trashed it or whatever. And so all of a sudden, the physical count of stuff that's out on the sales floor doesn't match what we have in the books. And so that end of the year, we are required by GAAP to do that physical count and then do an adjustment in the books so that the books match reality of the count that's out on the floor. Okay, so let's take a look at some samples of journal entries if we were purchasing inventory. And here there's an example if we purchased inventory on account for $100. Here it shows the periodic system, and we would debit the purchases account. For the $100, we would credit accounts payable. Of course, we'd also have the vendor name in there. We'd have the date listed, and we would have an explanation of the invoice number, etc. But we would be debiting purchases and crediting accounts payable for that $100. And this is what we did in Chapter 11. However, the perpetual system, we have inventory coming into the store. So every time it comes into the store, we're going to debit inventory. It's going out of the store, we have to credit inventory. But here it's coming into the store because we purchased it. Okay, and so we would be debiting the inventory account for the $100 instead of a purchases account. The inventory account, remember, is an asset. What about when we sell the inventory? So here's an example. If we sold merchandise on account for $80 and we figured out that the original cost to us of that particular piece of merchandise inventory was $50. So in the periodic system that we learned in Chapter 11 and 10, okay, we debit accounts receivable, or if we received cash for the sale, we would debit cash for the $80 that we received from the customer. Then we would credit sales for the $80. And of course, if we had sales tax payable, we would credit that as well. Now, in the perpetual system, we have the same journal entry for the sale part, the sale to the customer part. We're going to debit accounts receivable, or if we had received cash for the sale, we would have debit cash for the $80 and credit sales, just like we did on periodic. Only now we also have to figure out the cost, and that cost has to be credited. It's going out of the store, so we have to credit inventory for that cost. So the cost was $50 for that thing that we sold. So we're going to debit an expense account called cost of goods sold, or COGS, and we're going to credit the inventory account for $50. So we have two journal entries every single time we sell something. Okay, here we're talking about the count of the physical inventory. Remember, with the periodic system, we have to count at the end of each period. We have to do that. Counting inventory is a huge hassle. It takes large amounts of time. Okay, so you don't really want to have to be on the periodic system and have to count the inventory at the end of every month. Okay, and then we have to calculate out the cost of goods sold, to calculate out the ending inventory. Okay, and get everything all situated so the books are matching. Okay, whereas in the perpetual system, because we have done such a good job of keeping inventory up to date, we don't need to keep counting the inventory every month. Okay, now GAAP does require that we have to do it at the end of the fiscal year. So at least once a year, whether we're on the periodic or perpetual, we have to actually physically count the inventory. This is typically, we try to do this after business hours. It is a huge amount of time, normally a lot of money too. The business has to pay for extra, temporary people to come in to help with this job, etc. The ideal time to count the goods then is when our inventory is at its lowest levels. So we have what's known as a fiscal year. This is our accounting fiscal year. It starts and ends when the inventory is at its lowest level, so that we can do this inventory account when we have the least amount of inventory. So the big retailers who, a J.C. Penney or something, where they have huge amounts of inventory up through Christmas and stuff, they're going to have their end of their fiscal year, when the lowest amount of inventory might be the end of January or the end of February. Somewhere in there is going to be the lowest amount of inventory to have to count. So that's when they're going to set their fiscal year. So their fiscal year might start on March the 1st and go all the way to February 28th. And so the end of their fiscal year for their accounting records is February 28th. It doesn't have to be January 1st to December 31st like the calendar year is. So they're generally going to make their fiscal accounting year match to when the inventory is at its lowest point, will be the end of the fiscal year. When we're counting the physical inventory, of course, you have to count all the inventory that we own that's out on the sales floor, whatever. But there might be some situations where some of the stuff on the sales floor isn't ours, such as we have some goods held for sale on consignment. So these are other people's goods that are sitting on our store shelves. And when they get sold, then we get a cut, we get a commission, and the rest of the money goes to whoever owned that stuff. Now, it isn't our stuff, so we're not going to count it. when we count the inventory. However, if we own stuff that's at somebody else's store on consignment, that's our stuff, and we have to make sure that we count it in our inventory, even though it's not sitting in our store. Another issue is the goods in transit. These are the goods that are on a truck somewhere, or a ship, it's a train, whatever, okay? So we learned about FOB shipping point. That's where the seller only provides free up to the loading dock at their own place, and the buyer then has to pay for the shipping, for the trucking to get from the seller's loading dock to the buyer. And so once the stuff is loaded in the truck, it's now the buyer's responsibility, and it belongs to the buyer at that point. Title of the goods passes to the buyer at that point when it's on the truck. So if we're counting inventory, it's February 28th, and we're counting the inventory at the end of our fiscal year, and there's a truck 3 states away heading toward us with stuff that we own, we got to count it. Now, if the goods are shipped FOB destination, that means the seller provides free all the way to the buyer's place. So if we're the buyer, those goods are not ours. Title does not pass until the truck gets to our loading dock and the stuff is taken off the truck. Then they become ours. So we do not count them if they're still on a truck 3 states away, okay, if we're the buyer. Now, let's say we're the seller in this instance. In that case, if we're the seller and it's FOB destination, then those goods which are on their way out on the road somewhere, they belong to us, and we got to count them if it's our end of the fiscal year and time to count inventory. All right. Now, once we have counted the inventory and we know we have so many units of this and so many units of that, we have to figure out a way to calculate a cost. Because what if we were Lowe's and we had 4 hammers on a rack, and one of the hammers is way by the wall? We originally paid $2 for it, and couple of them we paid $3 for, and the one that's closest out on the edge of the rack was the most recently purchased one, and that one was $4. Now, we sell these hammers for $8, let's say, to the customer. And it doesn't matter which hammer the customer picks up, we're going to only charge the customer $8. But how do we know? We have to do that extra journal entry for the perpetual system. How do we know how much that particular hammer cost? They all have the same barcode on them. They all look the same. They're all the same model, everything. Okay, so how do we know when the customer brings it up to the cash register that it is one of the $2 cost ones, the $3 cost ones, or the $4 cost ones? Okay, so what we're going to do is we're going to calculate out an assumption of what that costs. And this is a job for the manager. Management chooses which cost flow assumption method they're going to use. And here are the 4 most common ones. FIFO, which means first in, first out. That means the first hammer in to the store is the first one we're going to assume is sold. Okay, so the $2 hammer, the one against the wall, has been there a long time because no one tends to reach toward the wall to get the hammer. They take the easiest, quickest one, unless something's wrong with it, and then they might go further into the rack. Okay, but this $2 one, it was sitting way against the wall, and nobody's gotten that one. But that's the cost flow assumption we're going to make. If we're the manager and we decide we're going to use FIFO, then when that customer brings up that hammer, and we're going to charge the customer $8. So we're going to debit cash and credit sales for $8. But for the cost of the hammer, we're going to use the $2. We're going to assume that the hammer that was the oldest on the rack is the one that's going out the door first, that's getting sold first. A LIFO is another common one, and this means last in, first out, which means the last most recently purchased hammer is the one that's going to get sold, the one that's going to go first out the door. So in this case, the $4 hammer is the one we most recently purchased. So the customer brings the hammer up to the cash register. We're going to debit cash and credit sales for the $8 that the customer has to give us, but for the cost part, we'll debit cost of goods sold and credit inventory for the $4 if we were under the LIFO system. Now, the average cost system is a system where we're calculating out the average of the 4 hammers. So we have one hammer at $2, 2 hammers at $3, and 1 hammer at $4. So all together, that's $12 of cost of hammers, and we divide it by how many hammers we have, which is 4. 12 divided by 4 is $3 per hammer. So in the average cost system, customer comes up with the hammer, and we're going to debit cash and credit sales for the $8, and we're going to debit cost of goods sold and credit inventory for $3, the average cost. Specific identification method means that we have some way of specifically identifying each hammer. So maybe on the $2 ones, we put a round red circle. And on the $3 ones, we put a green square sticker. And on the $4 ones, we put a purple triangle sticker. So when the person brings the hammer up, the cashier can say, oh, this is one of the green squares, so this must cost $3. And then they would debit cost of goods sold and credit inventory for the $3, the exact original cost of that hammer. Now, of course, that's ridiculous for somewhere like Lowe's to be going around putting all these little stickers just so that we can specifically identify the exact cost of that hammer. Where GAAP allows us to, and it's much easier and quicker to use one of these other assumption methods. We can use specific identification method, however, in certain situations. If the product, the inventory is very unique and the sales volume tends to be lower and the unit value is relatively high, then these are situations that lend themselves to specific ID. Now, cars are not necessarily a low volume item to sell, but yachts, there's only so many yachts sold. Fine art and fine jewelry, one of a kind pieces, these are not, zillions of them sold. And their unit value, how much they're sold for, is high. And they're all unique. That oil painting is a one of a kind. There's no other oil painting exactly like it. Yachts, every single yacht on the planet is made separately and is different in many ways from every other yacht that's on the planet. The cars, every car has a VIN number on it that specifically identifies that car. So these are things that the specific identification method can be used for. We're not going to really talk a whole lot about how to do this because if it's identified specifically, it's pretty straightforward. All the costs that went with that exact item are right there. You know, we can just put them into the journal entry. Now for FIFO, that assumes that, again, that the first goods that were purchased, the oldest goods that were purchased, are the first ones that we're selling. And the latest goods purchased, the most recent goods that we purchased, are still hanging on the rack, still in the ending inventory. Again, this is assumption. This can tend to follow the natural flow of goods for many businesses, such as grocery stores. So when you're buying tomatoes, you're buying the tomatoes that came in already, and the newest tomatoes that are going to come in haven't been sold yet. Okay, they're in the back and they're going to be put out. Okay, something like that. Fresh fruit stands, computer software businesses. Okay, LIFO assumes that the sales in the period were made from the most recently purchased goods. The earliest goods, the oldest goods purchased, are those that remain in the ending inventory in the store, as opposed to getting sold. Okay? Some justify the use of this method because the actual physical flow of goods in some businesses is actually last in, first out. So if we have a pile of plywood sheets, the plywood sheet on the bottom of the pile, which is the oldest one, is not going to be sold first. Okay, the most recent plywood that's at the top of the pile is going to be sold first. Okay, and it matches the most current costs of items purchased against the current sales revenue. Okay, and so this helps us with the matching principle that we learned about back in Chapter 5. The average cost system, again, it computes an average cost per unit using the formula like we did with the hammers. We add up the total cost of the units that are available, of the 4 hammers that are available, which was $12. We divided that by how many units are available, which was 4 hammers, and we came out with $3 is our average cost per hammer. Now this average cost in the perpetual system is going to move because we're purchasing new things that may add or subtract from that moving average, and we're selling things. So the average is moving up and down as time goes on. When we take a look at the physical flow of the goods versus the cost flow, and we talked about how sometimes different cost flows can match the physical flow. However, this is not important. It's not something that has to be. Management can choose a cost flow assumption that does not even remotely match the physical flow. So if Lowe's wanted on the plywood sheet, where we know nobody's going down to the bottom of the plywood sheet and trying to drag that one out, okay, of the oldest plywood sheet, they're taking the ones off the top, okay, the most recent ones. So you would think that if you wanted to match the physical flow, that you would use LIFO, but management doesn't have to. They can choose to use FIFO, even though it doesn't match reality. It doesn't matter. Any one of the methods may be used under any set of physical flow conditions. Does not matter. However, once a cost flow assumption is chosen, It is extremely difficult with either GAAP or the IRS to change it. Okay, so if you decide, oh, I'd rather have these plywood sheets be on LIFO instead of FIFO, now you have a huge, massive headache of redoing calculations for the last 5 years for GAAP to be able to change that. And you will be spending months and huge amounts of money to accounting personnel to be doing all that. The IRS requires, if you're going to change, you have to ask permission to the IRS. And you better have some good business reasons, not just, oh, I think my taxes will be cheaper. You have to have some good business reasons of why you want to change. And then the IRS may or may not allow you to change. Now, they definitely will not allow you to change back. So if they allow you to change, and if you go through the hellish experience to try to change it for GAAP, then you're never going to get to change it back again. So it's best if you're the manager and you have to make the cost flow assumption, it's best to really know what you're doing and to take a serious look at it and figure it out because you're stuck with it.